is our Real Estate Investing Made Simple Club. Hello, everybody. And welcome to our club. And we do live interviews with experts and leaders in the real estate investing world. And I'm LeAnn Riley. I'm a national real estate coach and a broker. I help ambitious people build a step-by-step roadmap to a six-figure income by creating a real estate portfolio of winning cash flow properties with my proven profit formula coaching program. And myself, I built a $14 million portfolio in residential, multifamily, condo development, commercial, and vacation properties. And I lead the Encore investment team of realtors here in the Twin Cities, Minnesota. We cover St. Cloud to Rochester and everything in between. So check out my Real Estate Investing Made Simple Facebook group. You can join that to keep up on what's going on every day. And stay on after the speaker, Tim, today, because we actually do networking with whoever's on here. Okay. And so you can meet other investors in the networking and get a chance to introduce yourself and talk deals. And hey, these meetings are where you meet people, right, Tim?
Yeah, absolutely.
Yep. So today's topic, creative financing and pivoting in life, because they go together. So we're going to find out today about some myths about mortgage rates. And boy, is that a hot topic. We're going to find out some landlord secrets, because Tim is both of those. But Tim and I are really keen on mindset activities, and we're going to talk about pivoting and mindset shifts. It takes courage, folks. We're going to keen you in on some of the things we do. So glad you could join us today. And I'm going to introduce Tim. Our guest today is Tim Swierzcek, and he is a true real estate entrepreneur, and he owns real estate investments. He's a mortgage originator with PCL Financial Group, and he knows how to pivot. He's been in this business a long time, just as I have as a realtor, and we rode that 2008 ordeal. We've seen the ups and downs, and you do have to pivot. Things change, and you just go with it. So I call him a mortgage geek, because he's in it kind of like I'm a real estate geek, and he's known for his ability to handle complex income and unique customer situations. And that's what you run into. And really, that's creative financing. He served on the board of directors for the Minnesota Mortgage Association. So again, he's been around. And I like to share, how did Tim and I meet? And, real estate investing is about networking, and we actually first connected through Bigger Pockets. And I could see that he was pretty darn knowledgeable, and he was really helpful answering people's questions. And so, of course, I had some questions. So, Tim, you're an investor. So tell us, what and when did you start buying investment property?
I purchased my first duplex back in December of 2003. So we're going on 19 years in about 10 days. I'm pretty sure we closed on December 24th, 2003 on the first one.
19. Yeah. Do you still own that one?
No, we sold it in 2019. So I don't still own it. Yeah.
But you kept it a long time.
We did. It was, we kept it for, what was it? Let's see here. We kept it a really long time. And, I think it's fair to say, I sold it because I started to realize that even though I was emotionally attached to it, there was other things I could do with the money. Right. And it was a good cash flowing property. There were a lot of reasons why most people like to keep it. But prior to that, I kind of had this attitude that I was always going to buy and I was never going to sell. And I actually think that can hold people back, that attitude. I think that sometimes there's a reason to reposition your money, reposition your assets. And at that point, I felt like I needed a different I needed to reposition. And part of it actually had to do with real estate investing kind of ends up becoming a lifestyle thing, right? And as our kids aged, our ability to be more active in our real estate investments, which we were in these local ones, changed, right? My wife was managing our rental properties at that time, but she had more that she needed to do with the kids and she needed to be around. So it made sense from a financial point of view, as well as like a lifestyle point of view to sell. I think that's a pretty good lesson. I think, you might not ever want to sell property, but that doesn't mean it's not the right choice.
I 100% agree with that. And actually, I met with my private coaching clients today. It's group coaching. And we had that exact discussion. You need to know the numbers on what you own. And if you can reposition that equity or what you have over there into something better, it could be time to sell.
Yeah.
You got it.
It was one of the things that allowed me to get into some larger apartments, right? And without selling that, I wouldn't have that other opportunity. So it's not really that I gave up investing. I just,
Moved it.
Reallocated the money. Yeah, exactly.
Well, and sometimes when you invest in the larger things with more partners, you might not have to do so. You might never get a phone call, right, about fixing anything.
Depends on your role. I get all the phone calls actually because I'm the lead.
Oh,
but it is a different thing, right? I can do it from my office, right, instead of having to drive out to a property or something like that.
yeah, because really you're just calling the people in your Rolodex, more or less.
Yeah.
To go handle things. I love you saying that, because even though I built my portfolio a long time ago with dial-up internet and barely a cell phone, I remember we still traveled all the time, and it was because I had a darn good Rolodex full of the right people.
Mm-hmm.
So it was a phone call away to get something to happen. I didn't have to be here.
Right. Yeah.
And
when we managed ours, we still had people doing all the work when it came to when it came to like fixing things, stuff like that. We had that Rolodex, but we definitely placed the tenants, advertised the units, stuff like that, and even some of the we definitely were pretty hands-on.
okay, before we get going, I'm going to run a very quick poll. Okay. And what I'm asking you listeners is, what type of real estate investing interests you? And this way, Tim and I can make sure we cover it. It's really easy. You just go on here and make a vote. I just put the poll up real quick. You just vote for, what is it? Are you getting started? Are you fixing, flipping, buying, holding, house hacking? What strategy are you working? We kind of want to know, so we know who we're talking to here. So here, and I'm only going to give you about 10 more seconds to vote. Oh, we got some starters, and then it'll show on here who's winning. So I'll count to 2, 1, 2, and I'm going to end the poll, and then I'll show you the results here. So what we have is the highest category is people are wondering how to get started. And then, we got the buy and holders and the house hackers. We've got some people in the BRRRR, that's the rehab, refinance strategy. We do have some short-term rental folks and a couple of scalers. So it's always great to ask this, because we do get a lot of categories, but really the winner is the buy or the how to get started. So, okay, I took down the poll, but that helps us see who we're talking to and how to get started. Those folks need mortgage help sometimes, because that getting started and so Tim and I are going to start out here talking about some, the big thing, inflation, recession, whatever. So we're going to talk about numbers and money, because you know what? Those are two of probably the most critical things in real estate investing. And how do these affect the bigger picture, which is our life? That's why we're talking this how pivot thing. So let's break down what's happening in the mortgage world first. You know, inflation is really influencing mortgage rates. So help us understand how that's happening.
Sure. Well, so to know, so inflation is the thing that affects mortgage rates. It's the number one, it's the kryptonite to mortgage rates. And the reason why is because a mortgage is, when someone invests in a mortgage bond, it's a long-term investment with a fixed low return. And when you have inflation, you eat away that return. It doesn't necessarily, because it's fixed, it doesn't go up with the market, right? Like if you buy a stock, in some sense, that company's profits will increase with inflation on some level if they're doing a good job, but that's not what happens on a bond purchase. Bonds are safer, but they get eroded. Your profits get eroded. So what happens is, as inflation goes up, you have to increase the yield to the bondholder, the person who's investing in it, which basically then raises the rate to the consumer, right? Because that profit to the bondholder is paid through the interest that the consumer pays, right? So that is why they go up. And so when you see when you see anything that is inflationary, that's going to cause more long-term mortgage rates to go up.
And we have inflationary stuff going on. So that's causing them to go
Sure
up,
do.
which is causing your mortgage rates to go up. Well, the Fed's causing that, aren't they?
Yeah, well, I tell you what, I've got and I did a presentation for a group of realtors on this. I think there's some handy slides I could go through real quick if you want me to. I'll try to go through them kind of fast so that we're not, dwelling on the subject, but I think it could be interesting and really give some people.
Yeah, go through them really fast. And I think, we need to know what's going on, and you don't get this a lot of places. So help us out.
And personally, I think if I were going to, even before I start, what I think it'll give people is peace of mind. One takeaway I would give people before I even start is, what's happening right now is normal and expected and shouldn't freak you out, right? I mean, that's just.
I like that. It shouldn't freak you out, because I just want to remind everybody, I built my portfolio in the 90s and the interest rates were 18%. And I didn't think twice. It was still all about cash flow.
Yeah.
It's hard for anybody today to even imagine what 18%, but yes, they were.
Yeah, I obviously I've seen all the stuff on that, but I luckily wasn't involved in the industry at that point. When I started, they were let's see here. I mean, I've seen sevens in my career, including recently, but I mean, when I first started, sevens was the kind of normal rate, and then we're dropping down in the sixes, and people are pretty happy about that. So.
And when I started, that was normal. That's I didn't know any different. I'm just like, okay, how am I going to make it work? This is how they do it. Okay, fine.
So I saw a question about the Fed and
oh yeah, I see it right there.
The Fed and raising rates. So I thought let's talk about this real quick.
Okay.
What this is really showing, if you wanna look at any, if you just look at this as a big trend, is what happens is when you see inflation go up, the Fed's reaction to that is to increase their rate. Now that doesn't in and of itself affect mortgage rates. Those are short-term rates. And by raising short-term rates, their whole purpose is to lower economic activity and reduce inflation overall, right? Inflation, in the most simple terms, if you want to think of it in the most absolute simple way, is you have too many dollars and too few goods. So if you can reduce the amount of dollars going out in the economy by reducing borrowing and even reducing spending, because people don't spend as much when interest rates go up, then you reduce the dollars so the dollars can match the goods, right? And then the cost of the goods doesn't keep going up, because the upward pressure really is, we don't have enough goods to give you and you have too many dollars to give us, right? That's actually what's going on. So what this really is if you just look and see over the course of history, the Federal Reserve raising rates, they'll raise them quite a bit. You can see here the Fed funds rate in this case went up 9%. In this case, it went up, a little less than 2%. And we've seen it go up quite a bit. I guess I haven't memorized how much it went up, but what it's went from 0 to we're in the 5s already, for the Fed funds rate, or actually for prime rate, I guess. So you see these big increases in the resulting response is lower inflation, and then mortgage rates drop.
Yep.
Another thing that you'll see anytime this happens is you'll see the stock market, the S&P go down, right? So if you have a stock portfolio and you've already seen some of this, but you'll see big drops, right? So people ask me, are we in a recession? I mean, I know it's been politicized, but I think it's pretty clear we're in a recession. Anyone who argues against that, I think really isn't doing it fairly or isn't doing it justice. And I think it's more political to say we're not in one than to actually admit, yes, we're in a recession. This is something that's interesting. When I tell you like things are predictable, even seeing inflation come down is more predictable than you'd think. And this is another important concept. When they measure inflation, they don't measure, a movie when my parents went to a movie was a nickel and now it's $20. They don't measure it that way, right? They're not looking over long periods of time. They're looking at what did something cost last year versus this year. And it's a rigged system. They're not checking everything. They're only checking things that they feel like they can control. And so they're looking at those particular items and going, how much have they changed? Well, if you look at this chart, what you're seeing on my computer screen here, and you can see it, correct?
Yep.
Okay. What you're seeing is you see how inflation was really low in July and August and September of last year, and then
Yep.
it bounced up in October. Well, that sharp increase is the floor. So if you're taking year over year, you've got a floor, you've got a ceiling. When the floor is down here, you've got really big inflation year over year. If this ceiling does not change, but the floor comes up quite a bit, which is what happened in October, all of a sudden you have low inflation, right? But guess what? Your cost of your movie didn't go down. When you go to dinner, that didn't go down. The ceiling hasn't went down. It's really just the floor has come up, right? We're actually seeing some signs of the ceiling coming down, by the way, but they're very small. But at least there's some relief, it looks like, that's going on there right now. And so these readings though are a month behind. So the guru that I pay attention to predicted that on November 11th we would see a big drop in inflation. Guess what happened? A big drop in inflation. Was he a genius? No, he just looked at a year ago and said, unless we see a major spike, a super big spike in the ceiling, inherently the inflation has to go down, at least how they record it, right? That's why I say, like, some of this stuff is obvious. By the way, don't be surprised if we see some really bad numbers in March of next year and even July of next year. It's very likely we're going to see that. And actually that March will come out right around April 10th to April 12th, somewhere in that range. So don't be surprised, don't be freaked out. It's nothing to be alarmed about, right?
Yeah.
Again, going really quickly, this might be a little more complicated for this, but it's just to kind of show you when the Fed increases interest rates. This is a past chart from the past couple of years where they raise rates, not in this time period, but back in the last crash or recession. When they dropped rate, this is like the Fed raising the rate, and then you see interest rates drop for a little while, then they come back up. Until the market is comfortable with inflation, you're going to see this bouncing around. So again, there was a question, do I expect rates to go up? I actually think they probably will keep going up a little bit more, maybe not at the same pace, but until the market is completely comfortable that inflation is under control, you're going to see this bouncing around. So again, going back to that theme, don't be surprised, don't be worried, don't be reactionary. That's some of the stuff I wanted to show you on that. I believe there's actually some other really good stuff when it comes to if you want to talk about, do we want to talk about recession anymore?
Yeah, let's hit it while you got your slides up a little bit.
Okay. So there are some indicators on a recession. One of those you've heard is the inverted yield curve. This is a chart showing inverted yield curves. Anytime you see the red, you have a corresponding recession with this shaded area. Red recession, red recession, red recession, right? Here's where we were. This chart is a couple of months old, but we are in the red here, meaning our yield curve was inverted for actually quite a long time. That's an indicator of a recession. Every single time there's been an inverted yield curve, there's been a recession to follow. Unemployment, same thing. Guess what happens during recessions? Unemployment is always at its lowest companies start laying people off at the start of a recession, unemployment spikes, right? And that is another indicator of a recession. So we had super, super low unemployment, and people started laying people off. This, by the way, this chart is roughly, I think, 3 weeks old. These are all the announced layoffs from major corporations.
Wow,
So the
look at
layoffs are happening. Again, another indicator of recession. The cool thing about a recession, though, like, are we in a recession? Absolutely. But here's a cool thing about recessions. Interest rates, what you see is you see a lot of volatility. You'll see them spike, but guess what happens at the end of every recession? They drop.
Oh,
Okay? Rates go up, very volatile, drop. Rates go up, very volatile, drop. Rates go up, very volatile, drop. Rates go up, very volatile, drop, up, drop. Okay. Why do I show you that? Well, that's to show you there's some real positivity here, but also when you're doing your planning, whether it's getting a mortgage or your real estate portfolio, you want to keep this in mind. How long does it usually take for this stuff to happen? Roughly 2 years. Okay. So I'm not trying to tell you that we're going to see a massive drop now, but I actually think that the recession, like that 2-year window, started at least a half a year ago or longer. And they've been extremely aggressive in trying to correct. Okay. Meaning that the Fed normally raises rates 25 basis points. They've been doing 75 or 50 most recently, but still 75 basis points. So they're trying to be really aggressive, because guess what's happening like slightly less than 2 years from now? It's called a presidential election. Those in power want to stay in power, so they need to turn this around quickly, and they're trying their best, right? Whether we agree with them or not, they're trying their best. And I believe that they're going to have at least the inflation thing under control, and they're going to actually start stimulating the economy before the election so they can point to good things. And if you believe that that's most likely true, then you also believe that there's a refinance opportunity, right? So we buy when assets are depressed, and then we take advantage of good rates in the future, and that's how you make a lot of money.
that's I love that, Tim. Okay, so are you good with the slides? Let's go back and
yeah, we can go back. Yeah, I think we might want to hit another slide or two.
Oh, then hit the 1, 2, because you're bringing up such great things, Tim. I really want to say, that's exactly where I was going. A lot of people are saying, okay, the rate is whatever it is, close to 7 today or whatever it is, but it's okay. In a few years, I'll just refinance. And really, from you showing me that, I feel confident that, yeah, that's a good strategy.
Yeah. And even if, so obviously we don't know the exact time rates are going to go down or exactly how low they'll go down, but there's some indication. So first of all, the average rate drop is 2.25 points at the end of a recession, which would still put us in the 4s, right? And actually, depending on where you gauge it from, like it could be lower than that. And that's without major stimulus. If they try to pop in stimulus to try to correct it, and you've heard of phrases called quantitative easing, and that was in some of those charts. If they start doing that, we could see rates in the 2s or 3s. I think that's very unlikely. For the record, I am not basing my business model on 2s or 3s, but I absolutely believe 4s are realistic.
Yeah, I was listening to another guru about his predictions, and he was like, 2024, we're probably going to see 5. And what you're saying kind of matches that.
Oh, for the record, I believe actually there's a very good likelihood of mid-5s in by June of next year. But that is okay. That's not necessarily a rate that's also going to stay forever. That is like, if we look at like what we think is how they're gonna bounce around, that's a very likely step we're gonna hit. Again, looking at how long it takes for certain things to go into effect, what we're seeing with rates, what we're seeing with that floor on inflation, right? I mean, all these things actually are much more predictable than you'd think, not to the precise of what the rate will be, but timeframes and stuff like that. You can get them within a few months sometimes, especially if it's more shorter term and you're not trying to be too specific on, is it actually 5.5 or is it close to 5.5, right? I think that's very possible. Something people don't normally think about in mortgages, but I think this is another good thing to understand, is that the higher your rate is today, the easier it is to refinance in the future. And how do you get a lower rate today? You invest money in it, right? So if you invest money into getting a lower interest rate today, you're going to actually make it harder for you to take advantage of a lower rate in the future. And you're going to potentially be wasting dollars today, right? Having said that, I do think everyone's situation is unique, and I have plenty of people I'm recommending they invest in dollars today, saying we're going to skip that refinance altogether. We're going to get you down to a place where it won't make sense for you to refinance in a year, but it still should in 2 years, right? And we're doing that for economic reasons. Their financial situation is such that they either couldn't afford or wouldn't want to afford the house without today's lower rate.
Sure. I love that. We do have a question here.
Sure.
Do commercial loan rates follow a similar pattern, or are we talking about residential rates?
Yeah, we're definitely talking about residential. My wife is the person who does all of our commercial financing. It requires different licenses, and I can only hold one of those licenses at a time, or at least work for one of those companies. But she office is right next to me, like right next to me here. So I hear them a lot, and I know that they're much more stable, first of all, because they're not traded. Most commercial rates are set by the bank, and it's based on their portfolio. They move slower, but they also move more with short-term money. So they're never subsidized. So we're seeing commercial rates, gosh, I don't know every situation. I can't tell you how this person got this, but I know for a fact she quoted with someone 6.39 the other day, which on a residential investment property, I think for most people you're probably pushing sevens, right? Even depending on how much you put down, even maybe 7.5. I don't quote that many residential investment properties. Actually, I refer 100% of those to my wife because I think they're a better option. And if we want to get into that, we can. Maybe in the question and answer might be more.
Yeah, maybe in the Q&A. I love that that's what creative financing is about. Use the tool that's available at the time that you're doing your purchase, knowing that those tools change, like you say, and why spend all this money to pay that rate down when you're not going to keep it for the long haul.
Yeah, exactly. And there are a couple of situations, because some people will be listening to this and they might not be on the Q&A later. I think so one of the situations where you'd want to buy a rate down today is if you're buying a house hack and you plan on moving in a year or a year and a half from now. Most people think they know that when you get a owner occupied loan, you have to stay in the house a year, but they think that's because of the purchase. It's not. It's because of getting the new owner occupied loan. So if you got an owner occupied loan today and you waited, let's say, a year and a half to refinance, then you need to stay in that house another year before you can get another owner occupied loan. If that's your plan, we have to think ahead and go, well, that's not very smart for us to plan on a refinance. We need to try to get you the best rate today. And in that situation, I'm telling people, like, let's go all in, but we don't go halfway. We don't say, let's get you a rate that's kind of good. We go like, how low can we go, right? And what I'm seeing for people, the best I've seen is a rate at 4.875. And the worst I've seen lately was like 5.25, 5.125, something like that. That requires very massive down. I mean, they are not for the sheepish. But guess what? The strategy we're using, and I wanted to talk about this, is we're having the seller pay it. Right. So it's not cash out of your pocket. Is
this the buy down, 2-1 buy down, 3-2-1 buy down, or whatever?
There's differences. I think that's a good thing. People are going to hear about them, and there's pros and cons to each. That what I just told you was not the 3-2-1, because that was actually a permanent buy down, right? Because we want something that's going to last a while. Time. Yeah. So permanent buy down versus 3-2-1 or 2-1. They're the same concept. They're just slightly different numbers. So first of all, a temporary buy down is more impactful on your payment, but it's by definition temporary. It's also cheaper. Okay. Permanent buy, and it does not affect your qualification, meaning that LeAnn, if you came to me today and the interest rate was, let's pretend it's 7, and at 7 you qualified for a $300,000 house, but you said to me, I really want a $350,000 house. The 2-1 buy down or the 3-2-1 buy down wouldn't be a good option for you, because it doesn't increase your ability to buy higher.
Right.
Even though your payment's lower, we have to base you off the 7. We don't base you off your payment.
Okay.
But on a permanent one, I could say, LeAnn, well, guess what? If we can get a permanent buy down, I can lower your rate, let's say, down to 5% even. And at 5%, now I can qualify you for, let's say, 350
instead of 300.
I don't know that that's the right math. I made that up, but it sounds about right. Actually, it might be more like 375 at that ratio.
So you folks who are listening, this is why I'm talking about Tim, and he's here for creative financing. That is creative thinking he's sharing with us right now, of how, like I know that people I've sent him, he's not going to put you in that 350 house with that 2-1 buy down, because guess what? In 2 years, you can't afford payment or whatever. It's not a long play. You have to be safe in real estate too. And if you can't come up with that extra money, or the seller won't give it, then that's probably not the house for you.
Right. That's exactly right. And I think like one of the things that I offer in general, and I think it's just really important. I think most people skip this, is they almost always are thinking short term, and I'm the opposite. I'm almost always thinking long term. Like, I know there are ways to make today's deal better, but if it makes tomorrow's deal worse, or it makes it impossible for you, if it takes you an extra, because you put too much to down today, it takes you 3 years longer to buy your next investment property. I know what the cost of those 3 years is on an investment property. I figured it out, and I share that with my clients, and I'm like, and in short, I'd say, like, look, you're going to lose at least $60,000 by putting this money down today, so that you can save $140,000 on your monthly payment, or whatever the number is. Right? I know I made all that up, but that is, I see people make those decisions all the time, and I'm like, no.
Yeah, they're not looking at the longer play. They're looking at a little, I got to get that interest rate lower, but that might not be the play when you're
Right.
building a portfolio.
That's correct. They're siloing the transaction, and they're optimizing one transaction instead of optimizing their whole portfolio, right? And I
Exactly.
feel like, let's optimize your portfolio. It's kind of like, if when you shop for insurance, yeah, you can get really, if your focus is on your car insurance because you have, like, say a bad driving record, you might make a really bad decision, because you might overpay for homeowners insurance to get what is quoted a cheap car insurance. But if you look at the total package and go, hey, my car insurance is even more with this company than it was with my current, but I'm saving $500 a year because the house insurance is so cheap. That's the portfolio thinking. That's the long-term thinking. And way too many people do not do that. They're just so concerned about today.
And you know what's interesting? Real wealth building is the long-term thinking.
Sure. Absolutely.
I mean,
Yeah.
it really is. And building real estate portfolios, you've got to think that bigger, longer term.
Yeah, absolutely. I totally agree. So I don't know if I covered 2-1 buy downs versus permanent versus
I
one
think you
thing I think
did. I mean, I clearly understood it.
you understand it. Yeah. I
Yeah.
will tell you this. So so the 2-1 buy down means that, like, if your rate were 7 today, you can pay a payment for the first year of as if it were a 5% rate. Your actual interest rate is still 7, but you pay the payment as if it's a 5% rate for 1 year. And then the next year you pay as if it's a 6%, and then the third you pay is 7. And the 3-2-1 just extends those numbers out 1 year further, right? You're going 4, 5, 6, 7 for your payment. The other cool thing that most people don't know about temporary buy downs, and one thing I really like about them, is that any unused funds go back off your mortgage balance. So think of it like this: if you're using LeAnn as your realtor, or LeAnn, sorry, as your realtor, and you negotiate a 3-2-1 buy down, and you only use the first year of that 3-2-1, that means there's essentially roughly 3% approximately in account sitting there waiting to lower your payment. That 3% goes off your price. You don't lose it. It goes off your mortgage. So it would just be like you had negotiated them to buy your payment down for a little while, but then negotiated your purchase price down the rest of the way. So it's very flexible. I like it for that reason. But just remember, it's temporary. It's a great bridge to get you to these cheaper rates that we're going to see in a couple of years. But you are literally just, it's really just the seller helping contribute to your payment.
It could put someone in trouble though, who, like we heard a lot about adjustable rates. They did that and now their period's over and all of a sudden it's up to whatever it is, and they really don't have that in their budget.
It's true. It can. That's one of the reasons why. So Fannie and Freddie require that you can only change 1% per year for that reason. There's a couple things. Number one, you know what it's going to be ahead of time. So, right, like, you're made fully aware, like, this is your payment for 12 months, and then the next 12 months is your payment. So there isn't any secrets there. So hopefully people can understand that. And secondly, I think for the most part, it makes people feel good. The reality is, like, You know what I mean? Like, I really truly believe that, you know, the
People like to
reality
have a
is
deal.
you have to be able to afford the payment at the 7%, or I can't even get you the loan. You
Yeah,
know what I mean? So to me, it's more of a comfort thing than a real thing. Now, the permanent buy down is the opposite. You're getting that actual rate forever, or if you're a 30-year loan for 30 years, right? So you are guaranteed that for the whole time. I did see someone made a question. I saw it fly by. You can refinance a permanent buy down. But permanent buy downs, like I said, are very expensive. So you kind of almost don't want to have to do that right away. You need some time for that permanent buy down to, you know, give you some benefit, right? You're trading today's dollars for future dollars, and those future dollars are smaller. So it takes a while for them to add up to the today's dollars. And you just want that trade to be a good trade. But for some people, so I'll tell you this too, it's a very powerful strategy. I'm doing 5 loans in the month of December. 3 of those 5 loans have very large permanent buy downs on them.
uh-huh. Okay, so Eric, can you put in the chat, can you see both of us or just him? My question here is, so you've talked about some creative ideas, and are you seeing deals with more seller financing now too, where you're just filling a gap somehow?
Sorry, can you repeat that? I saw one of the questions and it distracted me.
Okay,
I gotta
so
tell you the truth here, right?
no, I've had some recently, there's some seller financing, but not for the whole deal, for only a piece of the deal. Like,
Okay.
are you seeing some of that come across your desk now? And then the client
Well-
needs the difference from you?
Well, not for me, because that would have to be a commercial loan, right? So Fannie and Freddie Mac strictly prohibit that they say that's not even like, it's not like it's strictly prohibited. So on a
Okay.
residential deal, you won't see anything like that. But on commercial, absolutely. I think it's a good way to go. I am seeing lenders like, so that is one of the changes. One of the things you asked me to talk about was, are there, you know, is it getting harder to get a loan? On the
Yeah.
residential side, I would say no, it's actually getting easier. We just had a release from Fannie today, and they just made it easier to use business funds to complete a transaction, for example. We no longer have to do a cash flow analysis, right? And they're making appraisals easier and other things easier. The commercial
I
side,
love having this conversation, because the perception out there is, oh my gosh, it's all hell's breaking, it's gonna never work, but it does. You got to talk to the right people.
yeah, they haven't made it harder to do a residential loan in quite a while. I mean, they just slowly, and some of these things are subtle changes, right? Some things I'm talking about today would only affect you. Like if you're buying a mobile home as of today, it's easier. If you have a business and you need to use those funds for your down payment, it's easier, right? If you appraisals, they've slowly made some things easier on the appraiser and consequently on the buyer. Very minor though, very minor, right? But again, a slow progression of easier. Commercial, I would say, is the opposite. Like for example, at the beginning of the year, Nicole could do 80% HELOCs on investment properties at extremely low interest rates, like 1% over prime. And now, gosh, I forget how many over prime. It's a lot though. And it's 75% instead of 80, right? And that's a change. In the seasoning, we used to have a bank pre-COVID that had no seasoning requirement whatsoever on a refi. So if you're burring and you had the project done in 30 days, you could actually refi, and you had a signed lease. They didn't even have to move in, and you could refinance. Right now, that same company requires 1 year, right? So commercial wise, I would say they've gotten a lot tighter. And one of the things is we had quite a few people pre-approved to do exactly what you're saying. So they would get a loan from us. In this case, they would require 75% instead of 80, but they get a loan from Nicole for 75%, and then the seller would give 15% and the buyer would give 10. Okay.
Yeah.
We've done that before. Now they'll still do it, but they're going to pick the deal apart, and it's going to have to,
That's what I was just visiting a bank myself last week, and he said, geez, they had to require 35% down to make a deal work.
Yeah. And really, so the difference too is just so that your students know is that if LeAnn Riley came to me and wanted that, it'd be easier for me to get it than if a newbie came to me and did that, right? They're going to absolutely take experience into account with that kind of structure, because they know that they feel it's more risky. And they want to know if you're a good operator and you know what you're doing before you start doing that kind of stuff.
Okay, well, so this is calming to me that, go see the right mortgage person. And like right now, people are always saying, oh, but I think I better wait till next year. This is a lot of people. We got to wait till things straighten out. Well, the thing is, I just want to tell people this, there's a lot of opportunity out there right now. There's more multifamily on the market than I've seen in a long time. There's less competition. And you can sometimes save a lot of dollars in the winter. We're talking Minnesota here. It's cold. People don't want to go look. You have an advantage. There is little less buyers out there. And, I can attest to making deals on holiday weeks. They're out there because nobody else is out there looking. So go do it. Don't be one of those the waiters sometimes don't always make it, but you read the headlines and you're like, I better wait. The recession's going to hit and I'm in trouble. That's not always true.
I agree. And if I were to show you any more slides, that would be the topic that I'd want to be on. Because I can tell you, if you look at, so if your students understand that that we have a major housing crisis, right? There's and what that means is the amount of, so when only new construction counts towards new homes, right? Like any other sale is just a recycling of a home that already exists, right? Existing inventory. We finish building, like complete a house, about 1.4 million homes per year. We lose approximately 100,000 of those homes to fire and condemnation a year. So we net about 1.3 million homes per year. If you look at new household formations, which basically means a person who needs a new housing unit. By the way, this includes rentals, and so do both of those numbers include rentals. I'm not just talking homeowners. If you do that, we're at least 200 homes short per year, only on official stats. And when I say official stats, is going to sound I don't mean it to be political, but some people might take it that way. If you look at immigration, those are not all immigrations included in that. And if you include those numbers, we're short maybe as much as 2 million people per year. And you can devise that up however you want for household formations, but it's got to be at least 700,000 homes per year, every year.
Exactly. The whole point is here, inventory is not going to swiftly change. Yes, we have a little bit more now than we did last summer, but it's not going to be any quick fix.
Right. But even that inventory is it's just recycling of homes on the market. It's not new inventory, right?
No. It's just recycling.
Yes. New construction's actually taken a pause because of the environment we're in, right?
Right.
Because builders don't want to go to business, and neither do the banks who lend them money. So they've actually stopped building homes in mass, right? I mean, like, obviously, I admit there are a couple of homes being built, but in mass, construction has stopped, right? So, and it's going to take a while for them to start back up, and those homes won't be built. But guess what? Births didn't stop, neither did immigration, neither did people leaving their parents' house, right? So a new household formation is just LeAnn's kids going off to get their own apartment. It's not anything glamorous like going and buying a new house. So household formations are pretty interesting topic. It's like if someone gets divorced, that one house becomes two.
Right.
If people come together, whether it be marriage or not, that's one, right? They're actually, but when you look at it as a whole, very interesting. You can predict based on birth rates how many houses we're going to need. If you look at birth rates 33 years ago, you can predict with accuracy how many houses we need, and we are far behind. And why do you need to know that? You need to know that because the reason why we have inventory right now isn't because there's actually too many homes. There are far too many people, not enough homes, right? But the difference is people are scared out of their mind. And when people are scared, right? I don't remember the exact phrase, but one of the Rockefellers, or not Rockefellers, like the Vanderbilts or something, or Rothschild said something like, when there's blood in the streets, that's what I'm buying, right? Some form of that phrase. And guess what? I bought 4 homes this year and I want to buy 20 in the next 12 months. I don't think there's blood in the streets, but I think there's fear that makes people think there's blood in the streets. And that's good enough for me, because I think that interest rates 2 years from now are going to drop. And I think people are going to get out of their stupor and realize that housing has a major, major problem. And I think housing prices are going to spike like crazy. I think what you saw for appreciation during COVID will happen again in a big way. And anyone who is in it safely can ride out to that time, right? So I
I
don't have
love
to
what
be-
you said, in
Yeah.
safely, and
Yeah.
that's by buying cash flowing properties.
Correct.
Buying something, you got to know your numbers and it has to make sense. So I'm going to jump us over to mindset here because it's such a critical part of this. And you just touched on it. It's that fear that is driving, oh, I better not buy now, and watch the news and all that.
Yeah.
And, you know, you're buying right now. So how do you handle that fear? You know, like how do you handle that you're coming from a different place?
Well, I think we're being hit on the head with a hammer with the facts, which are so if you look at Case Shiller, which is an independent group right there. I mean, Schiller is what, a Harvard or Yale professor. I think he's a Harvard economics professor, right? They're not in the housing industry. They provide data to the housing industry, right? If you look at how many homes they said we were short last October, I'm saying October of 21, not 22. The answer was 4 million homes short. Only 6 months later, they're at 5.5.
Yeah, what happened?
Well, I actually kind of know, but again, I don't want to get too political.
Yeah.
It's immigration's the answer. It's really immigration. But having said that, it doesn't matter why we're short homes. It's obvious, right? That look, this housing crisis we have with people on the streets with homeless people.
Yeah.
It's not because they want to be homeless. It's because there aren't homes for them, right?
Yeah.
I mean, this is a real thing, and it's only going to get worse. It's only going to get worse unless we can build massive amounts of homes cheaply, and because of all kinds of reasons, that's not going to happen, right? And so how can I be confident right now? Because I know there's a supply and demand issue that isn't going to get solved. All that has to get solved is people have to go right between their heads and realize it. And as soon as they realize it, houses are cheap right now. I know you don't think that. I mean, not
I
you,
do.
but I know that people are listening don't think that. They
Yeah.
think super expensive. They couldn't be more expensive, and that they're unaffordable. And that's simply not true. And on many ways, it's not true because they actually are affordable. They actually are. They're much more affordable than they were in 2008 when you compare income versus payment, even today, even with 7% rates. But also,
you and I think alike, Tim, we always have, but I'm thinking of, I think it was 2 years ago, I did some sort of a live stream, probably on my YouTube channel. And I based the whole thing on the numbers from the 2040 plan that is put out around the Twin Cities. And these are exactly what I said 2 years ago. Even it's a matter of we don't have enough even, and that's why rentals aren't going away. We don't have enough housing. People need to rent, period.
Well, think about it this way. There's all the people who are interested in short-term rentals, and I'll raise my hand. I am too. I'm looking at finding a place in the mountains right now. And I hope I get one, but every time we turn a house into a short-term rental, we basically turn it into a hotel, right? It's not a place for someone to live.
Yeah. We take a rental off the market.
I think that's a minor part of the problem.
Yeah.
I mean, is it 1 million homes in the US? I have no idea, right? I've never seen that stat, and no one wants to release that stat, but even that in and of itself, if you did away with it and you waved a magic wand, you did away with it, it still wouldn't solve our problem. We have a major, major housing problem. And what that means is if you realize it, that puts you in an advantage. And so, yes, like to your point, you have to buy a property that will cash flow. I think it has to support itself. Like what cash flow means to someone, I mean, everyone's different, but if you're looking for a property in the current market to make you $500 or $1,000 a month, I think for the most part, you're dreaming. I don't think that's very realistic, but that doesn't mean you can't make money on it. It just means you got to be patient, and you got to have some safety. Where's your safety? To me, it's savings, right? So I'm looking at ways to get into deals where I'm not using my cash. I might be using an investor partner. I might be using a low down payment loan. I might be using some of my cash. I might be using some seller's cash, but very little my cash. Not because I'm greedy and not because, but it's actually because I know that if I have $200,000 sitting in the bank, basically all my tenants can stop paying me for a couple of years. It
Yeah,
doesn't
you'll
even
be
matter,
fine.
right? I am foreclosure proof, right? And to me, that is the ultimate sleep at night. Like, right? If
And that is what I mean sometimes about cash flowing properties. I'm just talking, might only be 100 or 200 in the right area. And
Yeah.
then you're good,
Yep.
or maybe you can add the value to make it cash flowing. And I know we had talked last year about, adding a dishwasher is $100 a month in rent. Like maybe you can add the, whatever it is you're going to do, but, don't buy with it negative out of the gate unless you know what to do to correct that.
Absolutely. Yep, exactly. Right. I mean,
Yep.
sometimes you buy it negative out of the gate, but that's simply because one unit's not rented and the
Yeah,
other
or
unit's
whatever.
rented, and you're going to fix it up, right? Yeah. Short term, you got a plan, everything else, yes. But that plan should be to correct it, to bring it up to a point where, and guess what? If it cash flows $100 a month or $200 a month at current interest rates, when it goes down 2 points, you're going to feel pretty damn good.
That's right. So, what do you have any, like me, for my mindset practices, I meditate, I manifest, I have a lot of practices. I exercise in the morning. I have a routine that I need to do.
Yeah.
Okay, what's he got?
This is called, if you can see the logo here, it's called Panda Planner.
Yep.
And it was started by some guy who got cancer. And he started doing that same thing. He started, gratitude, journaling, showing what he's excited about in the future. And he beat cancer. I had no idea if that was the reason, but he created a planner based on that and based on principles around focusing. So there's a focus of your day. There's planning, there's what's your today's priorities. It's not really to-do based. There are some to-dos in here. Anyway, my son recently told me he wanted to kick his life in gear. He's 14. I was pretty proud of him. So I bought him and I Panda planners, and every morning at 7:15, we meet at our counter, our breakfast bar counter island, and we plan for 15 minutes before he goes to school. We plan our days, him and I together.
I love it. I love it. He will, and his life will be changed from that simple 15-minute interaction, really. And I know you're someone who does that, as I do. And that's how I create a life I love, is by doing that. Setting up those morning routines or evening or whenever they are for you, it makes a huge difference. And then the other one is hanging with the people that also have that same energy or spirit, or, that same thing. It's so important who you hang with. You are the 5 people you hang with.
Yeah. It's you got to be intentional about those kind of things, right? Who you're hanging with, and also, what you want to do with your day, right? Otherwise your day will control you. And
in a minute.
I've only been doing this for a little while. I don't want to, I think sometimes people make it seem like this is not a 40-year thing I've been doing. I've always had goals and stuff like that, but this exact discipline is, a few weeks old at this point. But it is different. It changes what my plan for my day is and what my priorities for my day are. And what my intention for my day is different now. And some of the days it's been rest. I've been like, I'm feeling really wore out today. Today, I'm going to step back. I'm not going to push through it. I'm going to actually rest, so I'm better. I'm going to get what I need done, but I'm not going to try to do the extra, right? Because I'm an A type. I have no problem working 12 hours a day, but if you're not feeling good, maybe you should only work 8 or even 7, right?
And I've been practicing these things for over 20 years, but I still change them out. But right now, particularly, I really want to let you people know that some sort of taking a look at your habits can make a huge difference. And I tracked my habits even for 1 full month to see. At first I made a list of, this is what I really want to do every day. Just simple things like, I have dry eyes, put those compresses on, those kind of things you just don't do.
Yeah.
I'm like, why am I not doing that? That is for my own health and I'm not doing it. What's that about? So I tracked it all and checked it off, and it made my behavior change. Just being aware of, wow, like I have these choices. So I just want to mention that because we get to direct our own minds and our own thoughts, but we may need help, like a Panda journal or a something. Like
Yeah.
I run a coaching group, and I love this group. We're over 10 years old. It's my sisters. One lives in Hawaii, one lives in Minneapolis, and my niece, she lives in St. Cloud, and we meet every single week. And we've been working on a manifesting book for the last like 3 or 4 months. We do them together so we all create the habit.
You said it. So like a few those slides I gave you were based on the realtor presentation I gave. And the presentation was based on what I learned from the last mortgage crash. And my very first slide after like just my introduction, so to speak, but my first thing was our habits, right? So if we don't have habits, we aren't in control of our lives, right? So for example, if you don't have habits, you've got chaos, right? Essentially what it is structure is the opposite of chaos, right? And habits are what give you daily structure. Otherwise you're just random structure, right? Which is another way of saying chaos. So if I wake up at different times every day, then guess what? Some days I'm going to have a really great day because I'm going to have plenty of time to get ready. I'm going to have time to be intentional. I'm going to have time to do this, time to do that. Other days I'm going to be like, holy, whatever, I'm running late, and all of a sudden I'm going to miss that planning for my day and everything's behind now, right? But if I have this habit of meeting with my son every morning, both him and I start our day in a certain way, and we have some control over it. So it's those habits, but it's not just that, right? It's the habit of our going to bed on time. It's the habit of eating a certain way, right?
Absolutely.
Because anyone can have a big piece of chocolate cake, but if your habit is to eat a big piece of chocolate cake every day, then all of a sudden you're going to get unhappy with your body, right? Or whatever, right? So
Your
it's
body's unhappy with you.
yeah, it's what you do 85% of the time when it comes to food,
Yeah.
right? Like, so get in a habit of eating like 3 healthy meals a day. Then guess what? If you probably have a snack here or there, you're probably not going to go too far off the rails, right? But if your habit is I'll eat when I have time, now all of a sudden it's like, well, I didn't have time, so I had to stop at McDonald's, right? So, but if you're, you know what I mean? So like just building these little simple habits actually makes our life easier.
Oh,
We
it
all do
does.
great with routines. You see that with your kids, right? When you're growing up little kids, when you give them routines, they go to bed easier. They're happier. They like it themselves. We like habits. We just don't like to admit we like habits because we want to be this independent being, and we are independent, but man, the habits make the rest of everything else easier.
They do. And we live in a distracted world with social media and all that. And so do our children. And it's important to be responsible about that for ourselves and for them.
Yeah. And I'll tell you one other thing that I'm really trying to focus on. And frankly, this is what I'm not very good at right now, but that is, I am today here and everything, but I have lows in my day, is energy. In this current market, I think things are not going to come easy. You're going to have to work for them, and you're going to have to be ready. And guess what? Money likes speed, but you
It
can't,
does.
you don't have energy. Right. And so, and if I met you, LeAnn, I don't know why I keep saying that. LeAnn, if I met you for the first time as a client and I had no energy, I could have all the best information in the world and you wouldn't want to work with me. Or you might, but it might be lucky. You might only work with me because your realtor said you should, right? But if I come in with you and I give you all I've got and I've got energy, this is the first time we've ever met. You don't know me enough to know how I can perform for you, but if I come in dull and drab, I'm not going to get anything. Same with if you go meet with a buyer to go buy a house, or a seller to go buy a house off market, right? You don't want to be this person, right? You got to be there for them, and you can't do that if your habits don't create energy in your life, right?
Right. And, remember how at the beginning of the call, a lot of people are trying to get started in real estate investing. Just so it wasn't easy. Like when I got started, actually money was the big problem. I didn't, my then husband and we got started and we actually built a $14 million portfolio off $40,000. But I went to 15 places to get that starter money and nobody would help me until I put a screen porch and a deck on our house, or he did, the handyman. And we got a $40,000 home equity loan. And that is how we built the portfolio. But so it's not easy is what I'm trying to say. You might get those 15 no's from the banks or wherever, but it can be done if you have that energy and, work on your mindset. Like I was not going to take no.
Right.
No matter what. I went everywhere. And then it came to me, and same with, I have an ops manager now, Eric, and I needed to hire someone new. My other one retired, my other assistant, and I had put it out before and interviewed people, and it was just never could find the match. And I just held in, like this would be manifesting. I basically manifested. I know someone. And one day I was sitting on my back step, and right that moment, I know who it is. Yeah. And then I just created it. Yeah. He was already an agent on my team. I went to him and said, hey, I got something here. And he's great.
I love it. Yeah. Well, and one of the other topics that I think is important in this market is what is your focus, right? And so you were focusing on this and you were able to solve it, right? If your focus was on how bad your business was going to be now and how awful your life was because your assistant retired, you would have been looking at the negative and you wouldn't have been able to see the opportunity there, right?
Right. And first I did the old, and entrepreneurs, I know there's a lot of you on here, you can recognize that, well, I can just do it myself, because COVID, and then she retired, and then there I was, and I did do it myself for about 6 months. And then I'm like, no, this doesn't work. I don't want to do it myself. I stopped creating my next step is what happened, because then I got in the minutia again.
Yeah.
So I got to move us forward here, because guess what? We're at 5:01 already. And you can see Tim and I have a lot to talk about, right? So let's see, what can I end with?
Questions, or are we?
Anybody got any questions here? Go ahead. I said, I think you answered that about the household formations. You already answered that. Anybody else got any quick?
They're seeing softening in the market based on household formations. I think, there's no question that people are skittish about paying higher rents in some markets. And so you're seeing it soften in some, but actual rent growth last month based on, based on core CPI anyway, was up 0.7%. That was one of the biggest drivers of inflation last month was shelter. So I think it's very, I didn't see who answered that.
It's Dean saying that one. Yeah.
Dean, what I would tell you, I think that's actually very market specific answer. I think that if you're in Uptown, you should expect rents to go down. But I think if you're in New Brighton, you should expect them to go up. And so I think, you know what I mean? Like, so I think it's very market. But overall, so I will tell you this. I think there's a little bumps in the road, right? I am not here to tell you everything is rosy. I am extremely confident in the market, but that doesn't mean that I don't think you might have to take rents that are $100 lower for a year or two, maybe. I don't think it's two, by the way, but maybe. The question is, what's the long-term play here? And I think the long-term play is exceptional, not just good. I think it's crazy good. Okay. And that's what I'm basing my stuff on. I just want to be safe in the process. So I'm hoarding cash so that I have safety, right? Too many people make the mistake where they try to put too much down because they want to save. So the math is this. If you put $1,000 down on your mortgage, you save $7 a month. So to lower your payment $70 a month, you have to put $10,000 down, okay? If your tenant stops paying, is $70 a month going to make any difference to you at all? I know that no one can answer. I think the answer is no, right? But $10,000 will pay most people's mortgage payment somewhere close to 5 months, right? With no rent whatsoever. Now, if it's a duplex and you're getting half the rent, you could probably go a year with that one tenant not paying if you had that $10,000 in the bank. Make no mistake about it. The $70 a month will never make you happy. It'll make you not sleep good at night though, right? You're actually going to make yourself in a much riskier, worse position by putting too much money down on your mortgage. The other thing, and LeAnn, God, I don't know why I'm doing that. I'm sorry. LeAnn said is you put a dishwasher and you raise the rent, right? If you take that same $10,000 and you remodel most places, provided they need it, you're going to raise the rent way more than 70 a month. So there's an allocation of capital thing there. I guess the bottom line is this: don't listen to your parents when it comes to real estate investing, unless they're real estate investors. Listen to LeAnn Riley.
I love that, Tim. Yeah, don't listen. I love that too. Don't listen to your naysayers, for God's sake. If you have a question, call people who are qualified in the field. Tim for mortgage, us for real estate. Get advice from the people who are in the know, not the. Sometimes they say they said this. Who's they? The news? No.
Yes, absolutely. Parents love you, but they don't know how to invest, and they don't know how to put their capital, and they go to what seems like the most, the best option. It's actually almost always the worst. I see the advice over and over again. I'm like, and it's a palm to the forehead.
Okay, I'm gonna go over to share screen just so we can wrap up, and then we're going to network. So stay on, folks. I just want to show you how to get in touch with Tim.
Okay.
So first, I have a Facebook community. Absolutely go over there. It's Real Estate Investing Made Simple. You can find it on Facebook. And then Tim, okay, if anybody needs a real estate strategy session about coaching, or the Encore team that I run here of real estate investing agents, you can go to my website, and here's Tim's information right here. This is how you find Tim. You can go to timswierzek.com, but it's hard to spell that last name. So there's the phone number, 651-772-9000.
You have to be dedicated and know what you want, right?
Yeah.
To be a good real estate investor and to work with me.
That's right.